about the
during
dismantling. No problem. See, you would see in the road, many buildings are under they destroying the building, demolishing. In order to demolish, the company need to pay for some people.
Yes, third party.
So the scrap value is that. So the difference between the cost and the scrap value, we call it depreciable amount. Okay, now coming back to my question, no one answered me yet. How many methods of depreciation?
How many?
Methods. In calculating the depreciation, how many methods available?
The physics.
Physics?
The structure of the item.
No. There are minimum 2 methods. There are actually several methods, but very famous and commonly used 2 methods. One is straight line method. The second method is reducing balance method. So now what I wanted to say that an entity shall
yung straight kasi equal yung depreciation expense mo every month, equal straight yun. But
so when we discuss IAS 16, I will explain you in more. So straight line method actually every month or sorry every year your depreciation will be equal.
Equally.
But if it is reducing balance method, every year your depreciation will go down.
From malaki, paliit na paliit yung depreciation expense.
Yeah. So what I want to say, now last year you calculate depreciation using straight line method. This year you should also do the same. That's what I am talking about, consistency. See in balance sheet, you would see property, plant and equipment. Property, plant and equipment, we have a separate standard, IAS 16. You would see investment property, IAS 40. You would see intangible assets, IAS 38. You would see financial assets, IAS 32, IAS 39, IFRS 7, IFRS 9. You would also see investment accounted for using the equity method, that is associates, IAS 28. And then biological assets, IAS 41. Inventories, can someone tell me the name?
IAS 2.
IAS 2, very good. Inventory IAS 2, trade and other receivables, that's more specific standard, but this you can classify under financial assets. Cash and cash equivalents, IAS 7. So these are some of the line items you would normally see in a financial they call balance sheet or statement of financial position under assets. The total assets specified as held for sale. That's another very interesting standard, IFRS 5. And then trade and other payables, provisions, IAS 37, financial liabilities 32, 39, IFRS 7 and IFRS 9. Then liabilities and assets for current tax, deferred tax, IAS 12. Non-controlling interest presented with an equity, then IFRS 3, IFRS 10. IAS 27 also. Issued capital and reserves attributable to owners of the parent, IAS 1. So you will discuss all of this in time to come. And entity shall present, yeah.
Anybody want to see the balance sheet, income statement, once finished, come and show.
You can, I will also bring one on the next class.
From our one we can show. Your one you should have seen, this one, travels, you should have seen your one. Right? So you want to see, just we can show how it's actually.
Yeah. So an entity shall present current and non-current assets, current and non-current liabilities as separate classification in its statement of financial. One of the key changes of IAS 1 is this. Previously, IAS 1 is old. The updated latest version they talk about, you please classify your assets as to current and non-current. Your liabilities as to current and non-current. Except when a presentation based on liquidity provides information, then an entity shall present all assets and liabilities in order of liquidity. Why? If the company is under liquidation, if you are the company to close down, then we prepare financial something called breakup basis. At that time, we arrange in order of liquidity. Statement of comprehensive income. Actually, this is in normal from our childhood accounting knowledge, profit or loss account. But it is segmented into two sections. Profit and loss section, other comprehensive section, we put together, we name it as statement of comprehensive income. And entity shall present all items of income and expense recognized in a period in a single statement of comprehensive income. In two statements, statement displaying the components of profit and loss, and a second statement beginning with profit or loss and displaying components of other comprehensive income. Good example for other comprehensive income, revaluation surplus is one good example. There are many others. Revaluation surplus is the one major example. So these are, you will see in the profit and loss. Revenue, finance cost, tax expense, profit or loss, share of other comprehensive income, total comprehensive, all that you will see. This is the disclosure notes. Now, some of the, see, if you take a financial statement, there is something called face of the financial statement and as a notes. In the face of the financial statement, we are unable to disclose everything. If you write 3 paragraphs, in the profit and loss account face, you cannot write. So what you do is that, you give a reference number, note number 1, and you go to note number 1, you write that 3 paragraphs. So the readers can decide what to read and how to read and when to read. So accounting policies. We discussed.
So the contingent liability will come in the notes mostly.
Yes.
Okay.
I gave them a good example also. In life, I am sure no one will forget this. So whenever you see a cat sitting on the wall, you immediately will remember contingent liability. What I told them was, jumping, the cat is jumping from the wall to this side or that side, you cannot say. That is exactly the same thing.
May or may not happen.
May or may not happen. And the outcome could be favorable or unfavorable. Uncertain future outcome, which could be favorable or unfavorable, is what contingency is.
Like a court case, we took that for years. Maybe it will come out favorable for us, or maybe it will be unfavorable for us. We never know.
So, accounting policy is actually starting with accounting concepts, accounting basis, and accounting policy. Good example, accounting policies are, concepts are going concern, accrual, and so on. Then come to accounting basis. Good example, valuation of inventory. How many methods are available? Now these days are inventory count.
Going on.
Yes. So tell me, how many methods of what you call inventory count are available? Inventory valuation, not count.
Yeah. Yeah, only.
5-4, LIFO.
Weighted average.
Actually, but you know, this LIFO is no more.
IFRS
they don't entertain. But US GAAP is a different story. So we have FIFO and weighted average. So 2 methods. So that is accounting based. Then if you choose to value your inventory FIFO, that becomes your policy. So you have concept, you have base, and you have policy. Once you choose a policy, you should adapt to that policy consistently over the future periods.
Not 1 year FIFO, then another year weighted average.
You cannot change.
Comparability will be missing. You can't compare.
Then what happens? Suppose after 4th or 5th year, you have to look for the fairness on this change. In doing this, you have to refer another accounting standard, IAS 8. We will talk about that when that comes. Not inventory, IAS 8 is something else. And with this, we are done with today's session. And inshallah, Wednesday, we will start with cash flow statement. But today I will be sharing some questions for you to try.
Yes, sir.
And then if you want, send me an I will come. Jazakallah, thank you so much.